offshore investing has a bad reputation with South African investors, but recent changes in legislation have meant that local investors need to start looking at the role that hard currency assets play in their portfolios. We're looking at how technology and legislation have made it easier for investors to get offshore exposure and the difference between a rand exposure versus genuinely taking your money offshore. Joining us now for this discussion, Felix Ubogu, Head of Asset Consulting at Liberty Corporate. Thanks for joining us today, Felix. Firstly, let's just talk about the changes in legislation and perhaps changes in technology that enable us to take more of our rands offshore and put them into other currency assets.
If I can start with the changes in legislation that affect retail investors. The first is with the review of exchange controls that now allows a lot more of one's investments to be, larger amounts to be taken offshore. On an annual basis, one can take up as much as 5 million rand out, a million without any kind of clearance, but obviously a tax clearance is required for the additional 4 million. And on the institutional side, so now talking about pension funds and the likes, the revised Regulation 28 actually allows pension funds to take as much as 25% offshore, with additional 5% allowable when investing in the African countries.
Okay, and then let's bring in the conversation about technology and what role technology has played in opening up the world to local investors here in South Africa. I
suppose just with regards to awareness of the range or the broad range of destinations where one can actually derive value from. So both online as well as access to the internet has obviously made a significant contribution towards that. But I think technology, although it might facilitate an understanding of offshore investments, it really isn't one of the significant considerations which one should have when deciding whether or not to go offshore.
Yeah, I think maybe I just want to jump in there. I think that you got to differentiate between the traders, those that are looking for the offshore exposure through, you're looking trading either indices or maybe looking to trade your Johnson & Johnson, your blue chips. I think that there's a lot of developments that have happened from a technology perspective that says, I can now trade at a lot of the brokerages. You often got stuck in the old fashioned that only gave you the 400 JSE companies. Now you can pretty much trade anywhere in the world, any time on your mobile. And I think that the investment universe has opened up quite significantly for investors. I mean, I suppose one of the questions I'd have though is what's happening? Are investors actually taking advantage of the opportunity from a retail perspective? Are they using the advantage of getting their currency offshore?
I suppose I'm more equipped to kind of answer the question from the perspective of pension funds, because those typically are our primary clients. And we have seen a great interest in funds who are keen to kind of to move away from the domestic only balance and multi-asset class type portfolios to actually have some kind of offshore exposure. And I mean, there have been several reasons for it. I think if you attend any presentation or overview by any asset manager worth their dime, they will give you some very good reasons from both a valuation perspective and just prudence. The question is always, well, why is now a great time to go offshore? Actually, it's not just a matter of now, because it's in investments, it never should be just a matter of timing. There's certain reasons why it's always a good idea, and there's certain reasons why now is a particularly good time to go.
Because of the relative attractiveness as in less expensive? Or what reasons? Give us your reasons.
I think if I can pick up why now is a good time, the primary reason probably goes to valuation. So we all know that markets are mean reverting. We know that we've had a lost decade in the likes of the developed markets like in the US and in Europe, and we know that we've had a phenomenal returns from kind of our local domestic asset classes. And the theory behind mean reversion is that long periods of significant outperformance are followed by performances at mean or below mean, and long periods of significant underperformance are followed by periods of performance at mean or above mean. So if one looks at that and considers the scenario which the last 10 years you've had in the US and the last 10 years you've had here, and you believe in mean reversion, it's based on valuations or based on particularly that financial theory, it's absolutely a good time to make use of that particular.
I do have a cynical question that I'm going to jump in here, because I mean often we attend all the media presentations and you see all the asset managers saying offshore, and suddenly they're rolling out new products. Do you get the sense that they've just run out of ideas for the local market? And then I'll follow that up and ask, is it a case of saying, are they actually equipped to be able to manage offshore investments?
Yes, that's two very good questions. With regards to the first, are they running out of ideas? I think the one accusation which can be justifiably to an extent levied against asset managers is that they will deliver products that meet any requirement that come through the cycles or through the noise that the market participants or potential investors have. But if I can pause now and go back to my initial conversation where I said that there are actually two reasons one to consider offshore. There's the valuation perspective, which is what they harp on now. However, there are solid, sound investment principles that should dictate why a print investor should invest offshore. And in particular, that talks to the risk reduction benefits of diversification. The fact that if you introduce offshore stocks or bonds or whatever it may be into your portfolio, the overall risk of your portfolio drops down. Why that's quite key, particularly for a retail investor, is that with the trend towards daily transactional capabilities, if your risk is reduced, the volatility you're seeing in the value of your investments is reduced, the chance of you hitting the switch button, which we know, I mean, there's tons of research that says that destroys more value than it creates, that risk is reduced. And secondly, if you look at kind of our local market, you have at most 160 odd stocks. If you look at the MSCI All Countries World Index, you have close to 9,000 stocks. So just with regards, and if you appreciate the fact that investing really is about the possibility of the chances of actually getting good returns in the future, if you look at those two sets of universes, chances are that you can find those significantly value offering stocks by starting from a much larger investment universe.
I can see you're nodding your head vigorously there.
If you have a look at the research, basically a holding of about 35% offshore gives you the point at which you are maximizing your return and minimizing your risk.
At what point in time, though? I mean, at this point in time, 35% offshore right now.
Right now, but you're looking through a history basically over the last 10 years worth. And then the other thing, just adding on to what you mentioned about the investable universe, investing offshore actually gives you access to a lot of industries that we don't necessarily have in South Africa. I think one of the crucial things that anyone looking to invest offshore is the means that they should be looking at doing it. And one of those is looking at, for example, funds of funds, where the capability, the investment knowledge is enough that they have the understanding of exactly what drivers are basically moving the share prices overseas, and then also to make sure that you're looking at funds that are regulated. So, for example, funds that are based in Guernsey have to meet very strict regulatory requirements. So not just that they need to fall under the auspices of the FSB locally.
But I'm just opening it up onto the table, the discussion. I'm sure there are a lot of costs involved with going offshore as well. Yes. And then also currency volatility, and you're taking a view on the currency as well.
I think those who've invested offshore at the wrong time, so now talking about the early 2000s, who went when the rand completely blew out, and everyone thought, particularly economists, thought that this trend will continue going forward, have learned that a bet on the rand, a view on the rand, a focus on the rand is probably the wrong reason to go offshore. And in more cases than not, that will bite you. And it has bitten. And unfortunately, that, once bitten, twice shy. And those very investors are now hesitating to actually go offshore, potentially at a time where it's good. We've discussed the valuation aspects to it. However, it's not. I think quite importantly is if one quickly contrast local asset classes with offshore asset classes, they're very same equivalents. I'm talking about cash, bonds, equities, properties, and your alternatives, is that typically you have, from your traditional asset classes locally, you've got two drivers of returns. So you've got your income type returns. So if we're talking about equities, you're talking about dividend yields, and then you've got your capital gains. And you have the same thing on offshore equities, but you've got those two plus currency risk. And the problem is that if emotions are driving your need to go and invest offshore, or your thinking person to go and invest offshore, you are really just trying to play the currency part. And then the rand, for example, is known to be notoriously difficult to forecast accurately, consistently over time. So if that's the basis of the lever which you're trying to pull, in which you derive value from offshore, chances are you'll be burnt, and investors have been burnt. But I think it's important that the financial advisors as well as investment consultants remind clients before they take the plunge, so to speak, that there are three drivers, and one should evaluate across the board and see whether offshore offers value, and not really try and base it or pin it on a currency. But that really is not the ideal way to go. With regards to cost, your costs there are a lot of variables with your costs. So if you're retail investors, typically you pay more than your institutional investors will pay, particularly your pension funds. And depending on the means with which you use to get offshore, there are certain costs involved there. So I think for the average investor, for the average person, even if you don't have any kind of discretionary savings, chances are you're saving towards some kind of retirement. So you pay either a pension or a provident retirement fund through your employer, or a retirement annuity fund in your personal capacity. And chances are you use some kind of multi-asset class or balanced portfolio, and those are allowed to take the 25% offshore, additional 5%.
Do you think it's better for a retail investor, so we're talking retail now, to open up their own retail account, online brokerage account where you can trade stocks offshore, perhaps indices offshore, or do you think it's better to go for a unit trust here that has offshore exposure, perhaps 35% and north of that?
I think there are probably three considerations. One of them is complexity. Obviously, if you're doing it by yourself, you're doing it online, it's a lot more complex. You really should know what you're doing. The second is costs. Chances are if you're doing it direct, you incur asset management fees, you incur trading fees, and a whole set of other, a whole bunch of other fees. And I suppose it will differ depending on the circumstances of the individual, as we already kind of briefly alluded to. But typically, your most cost-effective and easy and straightforward means to go is to use a multi-asset class or balanced portfolio that actually where you have your professional, your more expert investors taking those decisions for you. Because the question then becomes, well, which of those countries should you be investing in? And you really are making potentially country-specific type bets, and between currency risk, country risk, you can introduce inadvertently a whole set of risk into your portfolio by doing so.
And leave that to all the analysts at the back of the